Hi, I'm Kunal. In this particular video, as you can see, we'll be understanding a very interesting strategy with the graph, that is long straddle. All right. So long straddle is a very interesting position when you are pretty sure that there will be going to be a lot of movements in the market, but you just do not know which direction. Say for example, today you're standing and you are able to predict that due to some event, the stock price of Reliance is going to move adversely. It might be the case that it might go upwards or it might go downwards, but you do not have an idea in terms of where the direction would be. So in that case, this is a very interesting strategy to build, where you take two positions, and these two positions are basically you take a long call position and you take a long put position, and you take at the money position. So when I say at the money positions, what I mean here is that the stock price of Reliance today, when you are taking the position, is 2400. That is a spot price. All right. And you take a put option, that is you buy a put option with an exercise price of 2400, and at the very same time you also buy a call option, that is you go long call again with an exercise price of 2400. So the reason why I say that this is a at the money strategy is because the spot prices are equal to the exercise prices. Now since you're going long call and long put, obviously the amount of money that you need to pay at the initial point is on the higher side. Already you're paying premium for the put option, and at the very same time you're paying premium for the call option as well. You all know that you cannot buy a single option in the markets, you have to buy lots. Alright, so lots are of different sizes. So say for example, this is just the price of one option. You'll have to multiply it by the number of options in one lot, and that will be the total amount of money that you'll have to deploy to particularly build this strategy. Alright, so to buy a put option for an exercise price of 2400, you need to pay 20 rupees. Alright, that is your PE. To buy a call option for an exercise price of 2400, you need to pay 25 rupees, that is your CE, call option premium. Alright, so together you are paying how much? You are paying 20 plus 25, the amount or the initial outlay that is going out of your pocket per option is 45 rupees. Alright, now you are willing to take this bet of 45 rupees per option because of your of some of your analysis. Because of some of your analysis, you are able to say that the market will move in a certain direction. Now see how it works out. On the x-axis we have the stock price. All right, so if we move towards the right, the stock price is increasing. If we move towards the left, the stock price is decreasing. That is pretty much easy to understand, easy to grasp. On the y-axis we have the profit and loss. All right, so this particular line, where the profit and loss is breaking even, are the price points of 2445 and 2355. Let me explain you the break even points, and then we'll understand the profits of this particular strategy. Now let's understand the break even on the higher side. Now say for example, the price has gone to 2445. Alright, the current price has gone to 2445. In this case, your put option is worthless because you'll not be exercising your right to sell the stock at 2400, because you're able to sell it for 2445 in the market itself. So this becomes worthless. The call option is in the money. It's worth, you're getting some worth out of it. What is that worth exactly? So you'll be buying the stock using your call option at 2400 from the party who might have done or might have taken a short call position. So you buy it for 2400, you go and sell it in the market for 2445. Alright, so you make a profit of 2000 rupees. Is this entirely a profit? Alright, you sell it for 2445, you 2400 was the initial price, exercise price, you make 45 rupees. This is not entirely a profit because this much amount of money you had used it to pay the premiums of both your options, that is your call option and your put option, and henceforth we call this the break even point, because whatever amount of money you are making by exercising your right at 2400 and selling it in the market at 2445, it's going to pay the premiums that you had initially paid to the short party. Now let's come on the left hand side, where say for example the stock price has gone to 2355. Alright, now currently the stock price is 2355. In this case, your call option is worthless. Alright, when you have the right to buy at 2400, why would you do that? You'd rather go in the market and buy it for 2355. So you'll not exercise your call option here. What you would do rather here is you exercise your put option. Alright, so you have the right in this entire put option, you have the right to sell it for 2400. So you sell it at 2400 rather than selling at 2355, which is the current price. So you sell it for 2400, buy it in the market for 2355. You make a profit of 45 rupees. Is this entirely a profit? Not really, because that amount of money has been used to pay the premiums in the initial case. So whatever money you are making at the price points of 2445 and 2355 is basically being used up to pay for the premiums of your option, and hence we are calling this the break even points. Alright, so break even points are pretty clear. It is basically the point at which the initial amount of money that you paid as a call option buyer and as a put option buyer is getting nullified. Alright, beyond that, either side, whatever the price moves, you'll make money there. So say for example, the price moves to 2700. In this case, you will be making money how much? 2700. What is your exercise price? 2400. So 2700 minus 2400, that is 300. You will subtract your premium amount here, that is 45. The answer that you would get is 255 rupees. Alright. So if the price moves beyond your break even point, on the positive side, you will make money. If the price moves towards, towards zero and beyond 2355, you will again make money. Say for example, the price has come to 2200. Now, if the price has come to 2200, again you'll make 200 rupees from the put option. The call option is worthless. You minus the premium amount that you paid originally, 155 rupees would be your profit. So this is how exactly your straddles work around. So the idea is pretty simple. Your risk here is limited, but the outlay is on the higher side. Your reward here is unlimited, given the stock price can move beyond 2445 on the upper side, and on the lower side again, if it moves to say for example 0.5 rupees or 0.8 rupees, you'll make a lot of money there. So the rewards are very good, the risk is limited, but definitely the outlay is on the higher side. What is your expectation in terms of the market or the stock? You are expecting that there will be a lot of volatility in the market or in that particular stock because of some event, and you are able to make this particular strategy by paying the premiums. Again, make sure the general anticipation in terms of market movement. Say for example, there's a budget day, or there's any finance announcement coming in from the ministry. On those instances, people already anticipate that, and they are already making their straddles. By the time you go to the markets and try to make your straddles, you would see that the straddles have been made, and the entire cost of making the strategy would be on the higher side. So again, your notion should be a little different from the market. That is when you'll get these straddles for a cheaper rate. Alright, so that is something that we need to understand in terms of volatility, risk, reward, and the returns that you will be making. So I hope you're able to figure out how straddles work around, and at the very same time you can apply the same methodology in terms of working out your condors, your butterflies, or triangles, a lot of which we'll be discussing in the upcoming videos. So make sure you keep watching them, and at the very same time, the moment that you apply a strategy, you see it on the chart and see how your payoffs work around. Thank you.